you are employed, if you are a salaried person, then you get 75,000 off. But the whole purpose of the new regime is to reduce the deductions.
So you can use the interest outgo from this home loan to set off against rental income from such properties.
So people don't realize that you do get the interest on home loan as a deduction even in the new regime. So just important to remember here that it's 14% 1/4 and 12% of basic salary, not your C2C. So usually companies keep the basic at a third of the C2C or a fourth. So if your C2C is a lakh a month, typically your basic will be 25,000 or 30,000 on the EPF contribution of the employer and on the NPS contribution, which is that it's on the employer side of it, not the employee side of it. Hello and welcome to Moneynomics with Mint, and today we're going to be discussing all about tax deductions in the new regime. Yes, you heard me right, in the new regime. And of course, one big exemption that the government has not touched in this budget. To guide us through all of this, I have my colleague Judge Triplani. Judge, so first let's talk about the deductions that are still there in the new regime. We have a nice list compiled. Do you want to take us through it?
So we have a lot of deductions and exemptions, not as many as in the old tax regime, but we have quite a few. To begin with, obviously there is standard deduction, which is 75,000 in new tax regime.
So this is if you are employed, if you are a salaried person, then you get 75,000 off. If you are self-employed, if you have a business, then you don't get it.
Right. And you also have employer's contribution to NPS, which is 14%, which is up to 14% of your basic salary. And there is also, employer's contribution to EPF, which is up to 12% of your basic salary. So that's also there.
Yeah. So just important to remember here that it's 14% 1/4 and 12% of basic salary, not your C2C. So usually companies keep the basic at a third of the C2C or a fourth. So if your C2C is a lakh a month, typically your basic will be 25,000 or 30,000. So of that, 14% or 12% can be the employer's contribution.
Yeah.
Which is deductible.
Yeah, right. And also, there is leave encashment on retirement, which is up to 25 lakh. That exemption is there.
Yes. So not everyone gets leave encashment. Anyway, it's a retirement thing. It's a once in a lifetime thing. It's not a recurring deduction. But actually, before we move to that, one point just to mention on the EPF contribution of the employer and on the NPS contribution, which is that it's on the employer side of it, not the employee side of it.
Right. Yeah, good that you clarified. Yeah.
Whereas in the old regime, it is there for both employer-employee under Section 80C. But the whole purpose of the new regime is to reduce the deductions, and therefore it's just one side that's available.
Right. So I was just talking about leave encashment on retirement up to 25 lakh, but then there are other prescribed limits. So that is a formula and all of that. Then there is also on gratuity, the maximum exemption available is 20 lakh, again subject to prescribed limits, etc.
Yes, so the way that gratuity works is that usually after 5 years you become eligible for it, and it is, as we discussed, tax free up to this amount, 20 lakhs. Not all companies have it, but if your company does provide it, then yes, you will get this exemption also in the new regime.
And also on the VRS amount, you have a maximum exemption up to rupees 5 lakh.
So again, VRS, a voluntary retirement scheme, is only there in some companies, typically PSUs, government companies.
Right. And then there is also, some set-offs you can do if you have rental income coming from a property that, where you have a home loan as well. So you can use the interest outgo from this home loan to set off against rental income from such properties.
Yes. So people don't realize that you do get the interest on home loan as a deduction even in the new regime. It's just that you don't get it on a self-occupied house. If you rent out that house and you're getting some rental income, then you can adjust the loan against the rental income. But that's it. You can't, if you have a loss, for example, if your interest exceeds the rent, you can't set off that loss against other heads of income like salary or business income or whatever else you have. So it is there, but in a more restricted format in the new regime.
Yeah, Anil, absolutely. And also the 30% standard deduction on rental income, that's also available. But yeah, like we were talking, if there is loss, that, like unlike old regime, can't be used
Yeah.
to set off against
Other
other
incomes.
heads of income or carried forward for that matter. So that restriction is there. And besides this, there are allowances, Neil. There are a few of them.
Yes.
You want us to talk about that?
Very quickly.
Yeah. So there is, like if say your company is sending you on an official trip to say Delhi. Now if obviously the company will be booking your flight tickets, etc., or you will be getting reimbursed money,
Which will not be taxed.
which will not be taxed.
Yes.
And the same goes for daily allowances, that if you are reimbursed on your daily allowances on such a trip, again, that won't be taxable.
Yes. So your taxi fare, your
Right.
your food, etc.
Right.
So that's it, right? We've covered
Yeah.
the list.
Yeah.
Now, so this is all there in the new regime. Now, there is one big exemption which the government has not got rid of in this budget. Age-old exemption. It's not even new. And that is if you sell agricultural land. So everybody talks about agricultural income being exempt, tax exempt, and that's true. Although it's a bit more complicated because it does affect your tax slab, even though the income is exempt. But the even bigger one is agricultural land is not considered as a capital asset. So question is, what is agricultural land? And there is a definition of that in the Income Tax Act. So Just, you want to take us through it?
So Neil, on the agricultural land, it is not considered a capital asset if it is a rural agricultural land. Now there are some criteria for that. Should we get into that?
Yeah, absolutely.
So there is population and distance criteria. One is the land has to be outside a municipal or a cantonment board,
Yes.
which has 10,000 or more population.
Yes.
But then there is a certain distance criteria that comes there. So the land needs to be at least 2 kilometers further away from the limit of the municipal or cantonment board. That's one.
If it's a 10,000 population
correct,
wala town.
Correct. Yeah, sorry. If it is between 10,000 to less than 1 lakh wala
Yes.
town. Sorry, if it is 1 lakh to 10 lakh wala town, then the land should be at least 6 kilometers away from the limit of municipal or cantonment board.
Right.
And if it is more than 10 lakh, then the distance needs to be at least 8 kilometers away from the limit of the municipal or cantonment.
So basically, the short answer is that your land has to be in a village. It can't be close to a city or inside a city. It won't. If it's there, it won't get the tax exemption. And since most of us live in metros, the real criteria for us is this 8-kilometer radius. It can't be within 8 kilometers of the big cities that we live in.
Right. Absolutely.
So if it's outside, you hear these stories of farmers getting rich overnight because government is building a road through there, or land is being acquired, or just the prices going up because city is expanding. So typically before that happens, your land will come within that 8-kilometer radius, and so you do get taxed. But if you're fortunate enough that you're outside the 8-kilometer radius, but there is a road or something being built there, then you don't even get taxed on the windfall that you get.
Correct. Right. And just one small point is that the distance needs to be measured as if it is on a straight line path. So road distance is not considered.
Yes. So it's not. So don't do a Google Map thing and then decide that you don't have to pay tax. Go to a CA. He'll probably do a proper evaluation.
Right.
All right, folks. I think that's it. If you have any questions, as always, feel free to reach out to me or Josh on social media, or put them in the comments, and we'll be happy to answer them.